On March 10, 2000, the NASDAQ Composite Index peaked at 5,048, 5 times its level 4 years earlier. Within 18 months, it would fall 78%. $5 trillion in market value evaporated. The dot-com crash ended the longest bull market in American history and the first great speculative mania of the Internet age. The origins were technological and financial. The Internet was genuinely transformative, but in 1999, investors priced every dot-com company as if it would capture an unlimited share of an unlimited market. Pets.com, Webvan, Boo.com, companies with no profits, no viable business models, and no plausible path to viability raised hundreds of millions of dollars. The standard valuation metrics of finance, price-to-earnings ratios, discounted cash flows, return on capital, were declared obsolete. New metrics were invented: eyeballs, stickiness, burn rate. Investment banks underwrote IPOs for companies they privately described as unpromising. Analysts issued buy ratings on stocks they described in private emails as a piece of junk. The Federal Reserve raised interest rates 6 times between June 1999 and May 2000, tightening financial conditions. Venture capital, which had funded the boom, began pulling back. When it became clear that the next quarter's losses would not be followed by the promised profitability, selling began. Once it started, the narrative of limitless internet growth that had justified the valuations collapsed. The crash was not instantaneous. It took 2 years for the NASDAQ to find its floor in October 2002. Along the way, WorldCom, the second largest US long-distance carrier, collapsed in the largest bankruptcy in American history at that time. Enron followed. The dot-com crash metastasized into a broader crisis of corporate governance and accounting fraud. The dot-com crash exposed conflicts of interest that had been visible but tolerated during the boom. Investment banks earned fees from IPOs they underwrote. Analysts worked for those same banks. Their buy recommendations served their employers' deal flow, not their clients' portfolios. The Chinese wall between investment banking and research had become a polite fiction. Venture capital had deployed capital into companies that could not sustain themselves. The model assumed that some small percentage of portfolio companies would generate returns sufficient to compensate for the total losses on the rest. When the entire portfolio declined simultaneously, the model broke down. Corporate accounting fraud, at Enron, WorldCom, Tyco, and others, revealed a broader failure of governance. Auditors had approved misleading financial statements. Boards had failed to oversee management. Stock options had given executives incentives to inflate reported earnings by any means available. The broader problem was the conflation of technological transformation with investment return. The Internet was indeed revolutionary. But revolutionary technology does not guarantee that early investors will profit. Most of the value created by the Internet would accrue to companies founded later, by consumers who adopted it gradually, and to the economy broadly, not to the IPO investors of 1999. The Federal Reserve, alarmed by the recession of 2001 and the September 11 attacks, cut interest rates aggressively. The federal funds rate fell from 6.5% in January 2001 to 1% by June 2003, a 45-year low. The monetary response succeeded in limiting the recession's depth. The Sarbanes-Oxley Act of 2002 addressed the accounting fraud dimension. It required CEOs to personally certify financial statements, strengthened auditor independence, created the Public Company Accounting Oversight Board, and imposed criminal penalties for securities fraud. Corporate governance was reformed by statute. The Global Research Analyst Settlement of 2003, a negotiated agreement between the SEC, NASDAQ, NYSE, and 10 major investment banks, imposed a $1.4 billion fine and required structural separation of research and investment banking functions. Conflicts of interest that had corrupted analyst recommendations were addressed by structural reform. The interest rate cuts that contained the recession, however, inflated a new bubble. By holding rates at 1% through 2003, the Fed made capital cheap, pushing investors toward yield in riskier assets. The housing market, already rising, was further inflated by cheap money. The cure for the dot-com crash seeded the conditions for the 2008 financial crisis. The dot-com crash destroyed approximately $5 trillion in market value, wiped out hundreds of internet companies, and produced a mild recession. Unemployment rose from 4% to 6%. The recession was short, 8 months, partly because the crash was primarily a financial market event rather than a credit system event. The surviving internet companies, Amazon, Google, eBay, emerged stronger and more dominant after the crash eliminated their competition. The wreckage of the bust paradoxically consolidated power in the firms that had been most capital efficient. The long-run trajectory of internet technology was not altered by the crash. The regulatory response, Sarbanes-Oxley and the research settlement, addressed the specific frauds and conflicts of interest that the crash revealed. But the deeper lesson, that speculative manias in transformative technologies are recurring features of capitalist finance, not one-time aberrations, was not institutionalized. The Fed's decision to keep rates low to support recovery demonstrated a fundamental asymmetry in central banking. It was easier to respond to busts than to prevent booms. The institution that cushioned the crash helped create the conditions for the next one. The Greenspan Fed's aggressive rate cuts, a pattern established after Black Monday, Episode 8, successfully contained the recession. But the tool that worked in 1987 and again in 2001 was creating the conditions in which it would ultimately fail in 2008. The patterns repeat. The faces change. The cost is always borne by those who had no say. Economic Crisis Explained. 2026.